credit, and it can't be that it is for BMR. Only about 2 days back, if I remember correctly, there was a news item somewhere which said that perhaps the thinking is going on that it will remain only restricted to the new industrial undertaking. Makes sense. But for the first time, to the best of my recollection in the last over 4 decades, if it is in the nature of a tax holiday provision, which it seems to be, then there are very many gaps which are there, very many elements which are missing. The qualifying conditions are put in the most vaguest terms. The qualifying period is not very clearly spelled out. And as is common with such particular sections, there is no enabling provision whereby it can say in the manner prescribed or according to the rules to be prescribed. There is no such thing. So even if tomorrow or day after or in the times to come, the FBR were to frame any rules, I'm afraid on judicial scrutiny, that kind of rule will be thrown out by saying that it is beyond the rule-making powers as far as this particular section is concerned. There is no enabling provision. And this is for 5 years, by the way, mind it. The tax holiday or the tax credit as they'll call it. And I don't know why were they so shy in calling it straight away a tax holiday, if they intended it to be a tax holiday. Because 100% tax credit of the amount of tax payable, while there is no linkage with investment, I spend 50,000 rupees on BMR and I get my 100% tax credit for the entire tax liability. Of all the tax provisions we have seen over the years in terms of tax holiday, in terms of 107 tax credit, and by the way, there is already a provision in the law introduced last year only, 65B, which is a tax credit provision anyway. Although there are again very many gaps in that, and nobody has taken the trouble of correcting that. It again does not speak of on what amount of investment the tax credit is available. They say 10% or 15%, whatever it is, of the amount of tax payable. Based on what? Linked with how much of investment? If I make 1 lakh of investment, I'll get it. I'll make 10 million of investment, I will get it. The entire tax liability for 5 years, starting July 1, 2011, or commencement of commercial production, whichever is later, it is unbelievable. So something has gone terribly wrong in the minds of those who have worked on this, unless I have been so naive in understanding the implications of this particular provision. Obviously, in a provision like this, wherever there is a tax credit, there ought to be a corresponding provision, which is there, fortunately, that if at any later date the Commissioner of Income Tax discovers that any particular condition has been sort of abused or flouted or not fulfilled, then whatever tax credit was allowed earlier will be clawed back. Fine, no problem. Such provisions do contain this kind of a safeguard. But what I am afraid to say that it doesn't make much of a sense that you give a tax holiday without defining the parameters and conditions within which this kind of tax holiday will operate. Now, unless something else was intended, which has not translated itself properly into its legal context as a provision, I can't say. But right now, this is a highly ambiguous situation. Then we have an amendment in section 111, a dangerous amendment. We hold no brief for those who are indulging in concealment or tax evasion or whatever you call it. And section 11 has been on the statute book for years, dealing with, taking into credit the books of accounts which you are not able to explain, assets acquired which you are not able to explain, expenses incurred you are not able to explain, and so on and so forth. 111 itemizes about 4 clauses dealing with a variety of situations. And it has been there for years in one form or the other. Even the 1922 Act contained what we call income escaping assessment in terms of these particular provisions. But what has been sought to be done and proposed to be done this time is, you know that although the intensity of this problem did become weaker with the passage of time when there was a presumptive tax. And let me hasten to add, I am not advocating or suggesting presumptive tax. All I am saying is that the intensity of this problem was somewhat blunted when the presumptive tax regime was in operation since 1991 or 92 or whatever. The rejection of the account version on one pretext or the other, okay? Sales rejected and the tax department estimates its own sales. Gross profit not in line with the past history or according to the norms of the industry, account version rejected. Fine. Suppression of purchases, account version rejected, so on and so forth. There is an amendment sought to be made in this clause D, which is now embedded in this concealment section. As a result of which, what will happen is, if your account version is rejected by virtue of an alleged suppression of purchases, sales or whatever, or any income which should have been taxed and is not taxed, then this particular provision will be invoked. Right now what used to happen is, if the income tax authorities have estimated your sales, your discarding your trading or declared version, then you do pay tax on that. And history of accounting version rejection would testify to the fact that if not all, and I have not carried out any empirical study for supporting this number, but going by hunch over the years I can say that more than 70-80% of such rejections were not upheld at the appellate forums, because most of the times they were done on whimsical grounds. Most of the time they were done on unsubstantiated material. And therefore, my worry is that instead of bringing in a reform in the tax process and the process of assessment, you are once again going back to the good old days of unfettered power and exercise of discretion to the tax authorities. On the flimsiest of grounds, your account version could be rejected and your sales could be estimated, and the allegation of suppression of purchases could creep in. And with the corresponding provision of this 111, you would be held to have concealed your income with all the penal and punitive consequences which the law contains. I am afraid if we want to make the process of tax assessment taxpayer friendly, as we used to have this expression in the tax reform days of the yesteryears, I think the lawmakers ought to have a second thought at this one. Would it further the cause of tax reform? Would it infuse and intensify taxpayers' confidence? Or would it give an unfettered liver in the hands of those who have not yet, after all these 60 years, learned to exercise judicious discretion in the exercise of these powers? And the history of the tax law is replete with such decisions where the courts have admonished them for having done what they have done. And despite that, once again in year 2011, when the world ought to be moving forward towards reform, we are again bringing back this kind of a provision. I'm sorry, this is something which every sane, responsible, honest taxpayer ought to take exception with. Minimum tax, as you know, 1% of minimum tax has been there since the early 90s. There's only one major, one amendment proposed, that the carry forward period for equalizing that minimum tax was 3 years originally in this provision. Now it is sought to be increased to 5 years. I take this to be a positive amendment. It will augur well, and I think this kind of a provision should have been there. 3-year period in the current scenario may look like a smaller period. This particular section also carries one amendment which includes in the definition of turnover the expression gross sales. To us as accountants, and way back in the early 90s when I had the occasion to deal with the erstwhile section 80D, which was in the 1979 ordinance, the corresponding one is 113 in the 2001 ordinance. We had defined turnover more or less in the same way as it exists in the 4th schedule of the Companies Ordinance 1984. But since that used the term gross receipts, it appears that somebody must have taken exception to 1% minimum tax being computed with reference to the gross receipts and not gross sales.